welcome back. Today I want to talk about debt versus equity. What are those two? What is leverage and how can I combine them? So first, equity in essence is the share capital that all the owners of the companies paid into the companies for the company to run its business. And debt, so the borrowed money in your company is referred to as debt. Now, how do you finance your business? By either one of them. So financing your business refers to getting additional cash to scale up your business, to pay expenses, to invest. And first, let's get into the equity part. Here you would raise capital and let other people participate in your company and also then profit from the merits of the company. And here you have your investors like VC, private equity, shareholders through stock exchanges, and even your family, friends and fools that invested in your company early on, as well as usually founders or high management roles have some stake in the companies. And pros of equity financing is you don't have to pay the cash that is injected into the business back. You have usually closer collaborations with your investors since they have more vested interest in your success. And this usually means that you can use their network, use their expertise. And normally equity investors have a higher risk appetite, so you can in most of the cases pitch riskier projects or whole businesses to them and still get the finance. Then the cons of equity financing is the first is obvious: you dilute your ownership. So the more people participate in raising or like gathering the share capital, the less ownership you have on your own company. This leads towards the fact that a lot of startup founders, even though it's their business, they run it and they still have management positions. With big companies, you rarely see equity stakes of these founders to be higher than 20%. And this means the merits of the company don't belong to you or only to you. And this also leads to the third con I wrote down. This is decision making. The decision making is going to be more difficult. You do have something called a principal agent problematic. So this means the investors, they have a vested interest in the successful running of your business, but they don't have real agency for themselves. So they have to leave an entrepreneur or a management team to run the business and rely on them. But this is often not very strictly separated, and oftentimes investors try to intervene into your daily business or into your operations and even your management style. And the last con I wrote down here is the high return expectation. So even though you don't have to repay your investors, they have an inherent expectation of what merit should be coming from the investments they make, and in numbers these are usually higher than 10%. So an investor with equity financing usually calculates with a number above 10% on which his capital should appreciate. You can see that with a lot of big corporates, they have pressure to pay out big dividends towards their investors. Then let's go to debt. Here I want to give you an overview of the debt financing models that I deem the most important ones. So first you have your short-term debt, and here we are, and here we talk about the cash conversion cycles. So if you are late to pay your suppliers and cash in on the checks of your customers early on, you do get a spread in your balance sheet that is actually financing your business. So that conversion cycle is one of the short-term measures that businesses use in order to borrow money. And then you have your classic bank loans or loans from other parties, and then you usually, for bigger enterprises, you do have your bonds. So you give something like a paper, like a share for the equity part, where you have a structured way of repaying the owner of said paper. So in essence, a bond is like a loan, but in a structured way, and is usually even traded at stock exchanges. And the pros of debt financing is you have ownership, or you keep the ownership and the control over your company, since grantors are not involved in the decision-making process as with the equity financing. Secondly, you have fixed and plannable costs, and usually if you have strong finances and if you provide them with collateral, if you have a solid business model, the costs are much lower than the expectations of your equity investors. So you could get corporate loans at 1-2% rates, and yeah, you see the difference, and that's what leads a lot of businesses to be over leveraged. I'll get into leverage later on. Let me finish the pros. You can deduct your interest payment as an expense from your business taxes. So this leaves you with a small advantage for your profitability towards equity financing. You still have cons, so you need to have solid financial background, and most likely you have to provide collateral. So this is related to the risk appetite of your financiers. Debt financing is more risk averse than equity financing, so the entrepreneur, the business owners, are more likely to get equity financing because it's easier to get because of these collaterals and financial checks that debt issuers normally ask for. And next con of debt is the pressure on your cash flow. So even though the costs are plannable and oftentimes lower than for equity financing, you need to pay it steadily, and oftentimes you have in your debt service not only interest but also amortization. So what means that you need to pay back chunks of the initial investments back to your lender. And the last con of debt financing is that you can get into vicious cycles if you don't manage your debt well. So this means if you are in financial distress, and the more difficult your situation gets, usually lenders want to be rewarded for the risk by still giving you cash, so they will increase the interest payment that you need to pay to finance other debt that you may even use for debt service for previous lenders. And this can lead you into vicious cycles when your firm is over leveraged. Leverage, or this leverage, this refers to the ratio of your equity to and your debt, and the idea behind this is that you as the business and its stakeholders formulate or bring up a bunch of cash, and a bank and other lenders, they multiply the cash that you put since the interest rates on those are fixed, you usually get all the excess profit that is not used for interest payments towards your own dividend or return. So let's say you and all your investors put together 1 million for your business. So maybe you have 20%, you put down 200k, and some VCs helped you with another 800. The expectation of you and them are 20% return on your investment. So you want to get 200k a year back from your. Let's say that due to the structure of your business, you only are able to achieve 10% return investment. So every dollar, every franc that is put into your business only returns 10 cents. And this would mean leave you with a ROI of 10%. And here's where debt can be used to leverage your company in order to still be profitable or sensible investment for your VCs and for yourself, for the equity investors. If you take on 4 million in debt with an interest rate of 2%, you have a profit of 500k with your ROI of 10%, because every dollar you put into your business generates 10 cents. This would mean you have $5 million you would get. From that, every year you need to pay 80k as debt service towards your debtors, so the 2% on the 4 million, and this would leave you with 400k net profit. These profits, or these 420k's are attributed to your equity investors. So the debtors are out of the game as soon as they got their 2%, regardless of the profit that the company makes. So all of these profits are awarded to the investors, what would mean they will get 420k a year for their $1 million investment, and this would exceed the expectation of 20%, even though the business is not generating as much cash, as much profit as it should in the eyes of the investors. And this is an example of how leverage can lead you to run a business model with investors that would not be interested into by itself. And the two most prominent industries that you see the structure of leverage being used on a daily basis are real estate and private equity. So they have leverage as one of the key instruments in their business. So we are talking about big corporations in order to have it easier to look at. But the differentiation between debt and equity, as well as their balance and the concept of leverage, is even interesting for small companies and even startups. If you look at how you can bridge your company, even short-term debt as cash conversion cycle, and pay your bills late, that is equivalent to a debt that is interest-free. So concept of leverage, important takeaway: debt and equity